Credit default swaps, CDS, are financial derivatives used to transfer credit risk from one party to another. They are contracts in which one party, known as the protection buyer, makes periodic premium payments to another party, known as the protection seller, in exchange for protection against the default of a particular reference entity, typically a corporate or sovereign debt issuer. While CDS can be useful tools for managing risk, they also carry several risks and are subject to regulation. Let's explore these risks and regulations in detail. Risks associated with credit default swaps. Counterparty risk. CDS contracts expose parties to counterparty risk, which refers to the risk that the protection seller may default on its obligations. If the protection seller cannot fulfill its contractual obligations in the event of a credit event, such as a default, the protection buyer may not receive the promised protection. Basis risk. Basis risk arises when the credit events defined in the CDS contract do not precisely match the actual events that trigger credit defaults. This can occur when there is a mismatch between the reference entity and the underlying assets, or when there are differences in the timing or valuation of the credit event. Basis risk can result in the protection buyer not receiving full compensation for the losses incurred. Liquidity risk. CDS contracts may suffer from liquidity risk, meaning that it may be difficult to find a buyer or seller for the contract when needed. This can make it challenging to exit or unwind positions, particularly during periods of market stress. Illiquidity can lead to wider bid-ask spreads and increased transaction costs. Market risk. CDS prices are influenced by market factors such as changes in credit spreads, interest rates, and general market sentiment. Market risk arises from the potential for adverse price movements in CDS contracts, leading to potential losses for the parties involved. Operational risk. Operational risk encompasses the risk of errors, failures, or disruptions in processes, systems, or controls associated with CDS transactions. This includes risks related to trade processing, documentation, settlement, and technological infrastructure. Operational failures can result in financial losses and reputational damage. Regulation of credit default swaps. Dodd-Frank Act. The Dodd-Frank Act, passed in response to the 2008 financial crisis, introduced significant regulatory reforms for derivatives, including CDS. It mandated clearing of standardized CDS contracts through central counterparties, CCPs, and imposed reporting and record-keeping requirements. It also introduced regulations on capital and margin requirements for non-cleared CDS transactions. International Swaps and Derivatives Association, ISDA. The ISDA is a trade association that has developed standard documentation for CDS contracts, including the ISDA Master Agreement. The ISDA also plays a role in promoting best practices, market transparency, and standardization in the CDS market. Basel III. The Basel III framework introduced by the Basel Committee on Banking Supervision includes provisions related to CDS. It establishes capital requirements for banks that hold CDS contracts and sets out guidelines for assessing their credit risk and determining appropriate risk-weighted assets. It establishes capital requirements for banks that hold CDS contracts and sets out guidelines for assessing their credit risk and determining appropriate risk-weighted assets. They monitor market participants, enforce compliance with regulations, and work towards enhancing market integrity and stability. International regulation. CDS markets are subject to international coordination and cooperation through organizations like the Financial Stability Board, FSB, and the International Organization of Securities Commissions, IOSCO. These bodies aim to promote consistent regulatory standards, improve transparency, and mitigate systemic risks associated with CDS trading. It's important to note that regulations may vary across jurisdictions, and the above examples represent some of the key regulations implemented to address the risks associated with credit default swaps.